Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, February 3rd, with the big boss, the Moose. We're going to discuss some fixed income. We're going to discuss some equities, how we may be positioned going forward. A couple quick things. I know John's going to touch on what the Fed said, and then what some reports came out, labor-wise and so forth. Very interesting. Interesting how equities reacted. In some previous months, some of the language out of Powell would have really sunk equities.
Correct.
Right?
And did.
And did in previous months. Today, the employment report, those kind of numbers previously really would have battered markets. And markets are off today, but not to the extent that we had seen 3 months ago and 6 months ago, as some of the pricing gets sunk into these markets. We often talk about markets getting things priced in, and it appears to be happening. I did mention last week, John, before we shoot over to you, that I would mention something in terms of momentum. And I do want to point out, we've said the worst actors of 22 have been the best actors of 23 through January, and mostly that's in the growth camp. I want to bring up a chart to take a quick look at. What you're looking at here is a 10-week chart of the growth portion of the S&P 500. And what the 10-week chart does, it measures the percent of stocks trading above their 10-week or 50-day moving average. This is not a buy or sell signal. This is like a temperature gauge, John. Right. So what I like to use this chart for is if I have money to put to work, or if I am underweight or overweight growth, I like to see where my opportunity is.
Right, exactly.
And what this chart is showing is growth from a 10-week standpoint has gotten up to the point where it tends to start to run out of steam. It's used so much of that demand, so much of that capital to push it up here. A pullback becomes almost the norm.
Right.
And you can see just by that yellow line going back previously, we're at a level over the last 12 months that if you're looking at growth, and people are chattering about it,
sure,
understand you may get a better shot in here than where you are today. So I just wanted to point that out. Value not as overbought. Remember, value was a nice trade last year. I happen to think it'll continue to be a nice trade as far as relative strength goes versus growth.
Sure.
But that doesn't mean that's what'll happen. The market will dictate how we position.
Exactly. And you look at this week, on the bond side, we had really two things happen. We had the Fed decision on Wednesday. That was a bump up of a quarter point in the Fed funds target rate, so it's now 450 to 475. Interesting, that was kind of baked in the cake.
Right.
And the language that the Fed had in there was important because it was the same language as the Fed had a few months ago, except they didn't try to disavow them of it. And it was basically, we're going to take into account the cumulative effect of the previous rate hikes in policy going forward. And the market was fine with that. And right. What the market looked at was not the fact that it was a 25 basis point hike. The market looked at it is that in the last hike in December, it was 50 basis points. Now it's 25. Before the 50, it was 75. So the pace of the hikes was slowing down. Now, today you get a jobs number, and the whole week coasts along with bond yields down 15 basis points or so across the board. And then you get today, and the jobs number, which is expected to create 188,000 jobs, was 514,000 jobs. And it's like, boom. But by the time you're done, you take a point and a half off the long bond, et cetera, you're essentially basically where you were last Friday,
right.
Give or take a few basis points. So you say to yourself, net on the week, not a whole lot of change. Munis this week, kind of ground yields lower. A week where you didn't get inflows into munis, had slight outflows, but they weren't much. But also not much of a calendar. So next week they have a little larger calendar, we'll tell. But the backdrop to all of this in bond land is the fact it's an easier mentality out there. People are living with the Fed and what they're doing, and they're not going crazy. And that's feeding into the equity market, no question.
You know, markets adjust.
Right.
Right. That's the biggest thing that sometimes we take our eyes off. Traders take their eyes off. They try to extrapolate what's happening in, say, August or September forward.
Right.
Markets adjust. You see companies with layoffs if margins are being affected.
Totally.
Companies adjust.
What?
We'll see where that goes. And, you know, let's go back a couple of years ago, John. You and I on our call said the one thing we were concerned about in fixed income when we were talking about higher yields was the spike higher.
Right.
Because if it was a grind higher, markets adjust and are able to price in that grinding movement higher. The spike, that takes everyone off balance.
Right. And the spike came because the Fed moved probably later than they should have.
Right.
And the catch up that the Fed was doing is what really spiked the market.
Right. Good information.
Right.
Don't forget to like, comment, and subscribe so you can follow along with our weekly videos. Have a great weekend. We'll see you next Friday.